Welcome to Bloomberg's Women, Money and Power event in London. I'm Anna Edwards. Bloomberg is bringing together the world's leading female voices in business, financial markets and economics. Top executives will share their expertise and insights on market risks and opportunities in a time of geopolitical upheaval and an artificial intelligence boom. And we'll discuss the role of private markets in financing it. We'll bring you that and much more on this special coverage of Women, Money and Power.
I think we are in such an incredibly exciting moment with AI. It is really the most profound technology of our lifetimes, and I think it has the potential to help us rethink literally everything.
The number of companies who are staying private or going private and company formation in the private land is also increasing.
There are 40% fewer public companies today than there were 20 years ago. So what's driving that?
That notion of just buy the S&P 500, if you own that for the last couple of years, you would have been just fine. It's all about making sure that portfolios are very diversified because it is difficult to price in the uncertainty and volatility.
The disconnect between geopolitics and the markets, and it's very striking to see that, and even this morning, whatever happens, the stock market keeps rising worldwide.
I do think government working in partnership with the private sector is actually making the right moves. We put a lot of pressure on them and they respond.
If you don't have scale, your ability to train your AI models, you're going to be left behind. And data is very expensive. We know because we buy it from places like Bloomberg.
The chatter around the future of artificial intelligence has hit fever pitch this year. It raises questions around how the technology will reimagine jobs, consumer behavior, and more. Bloomberg's Francine Lacroix spoke to Google's EMEA president, Debbie Weinstein, about the wide-ranging impact of the technology.
The potential for economic impact, societal benefit is honestly boundless. When we think about the economic impact for Europe in particular, it's around a 1.2 trillion euro estimate of the productivity growth that can be unlocked for the region, which I think is urgently needed given the growth trends that we've seen in the region kind of over the last 10 years and the difference of relative growth rates certainly between here and the rest of the world. We need to make sure regulations are in place because I think this technology is incredibly powerful and it deserves to be regulated, but it needs to be regulated well. And I think currently in Europe, there's something like 100 different pieces of digital legislation that have been written since 2019. They conflict with each other. They are not clear on what the outcome is. And I think there's a real need for simplification and harmonization so that we understand how do we actually get our best products.
Google's EMEA president speaking with Francine Lacroix. The AI boom has sent global indexes to record highs and created several trillion-dollar companies. Governments and firms are racing to build out the infrastructure to power and distribute the technology. Bloomberg's chief content officer, Heather Harris, caught up with figures from Carlyle and Brookfield on everything from the data center build-out to how we're going to finance and power the so-called AI industrial revolution.
We typically invest in asset-oriented businesses or projects. And in general, our markets are used to seeing growth, which is along the lines of GDP growth. It tends to be low single digits in the Western Hemisphere. Maybe you get to high single digits in emerging markets. What AI infrastructure is leading to is a step function change in the demand for infrastructure assets. If you believe any of these numbers, whether it's 7 trillion or 10 trillion, these are significant numbers that are creating a significant demand pull for certain infrastructure assets. And to just, elaborate on what Hadley was talking about, which I completely agree with, the kind of infrastructure that you're talking about is not just the data centers themselves, but the infrastructure that enables the build out of those data centers. So power generation capacity, transmission distribution upgrades, water processing capacity, fiber connectivity, all of those numbers are related and they all fall within the infrastructure investing mandate.
I think we should move on to the risk in the interest of fair-minded and balanced journalism, as some of my colleagues were talking earlier. We have seen some analysts, investors start to talk about bubble risks when you start talking about a $7 trillion investment opportunity. I guess one of them is in the concentration of power of the customers for these data centers. So one of your competitors, for example, is comparing it to the gold rush in California over 100 years ago and saying that okay, the people who sold the picks and shovels, now the data centers are going to be the winners. And yet in this environment, there are only really a handful, maybe a few more, people who can buy these extraordinarily large picks and shovels that we're talking about now. So can you talk a little bit about the risks of only having a few customers for some of these large-scale projects?
Well, I'll kick off actually on something that Pooja said, and then I think she's got some additional thoughts as well. But one of the words that we keep saying is infrastructure.
Yeah.
And so infrastructure, long-term predictable cash flows, long-term take-or-pay contracts. And so from that standpoint, you have a lot of mitigation built in to any type that's being built on spec. And so if you go back to those days, and you can pick any kind of asset class, I mean, the gold rush is one of those, what we're doing is the backbone, right? This is the infrastructure of this. And so it should have the infrastructure characteristics in order to mitigate that.
So, if you think about building out a hyperscale data center, depending on the size of that project, you are well into the tens of billions of dollars for the total capex of the project. And that includes different sources of capital to fund that aggregate capex amount. It will include project financing. It might include junior debt or subordinated debt, preferred equity, and then equity. And so if you want to find the most efficient cost of capital for the entirety of that capital stack, you do need to have contracted cash flows in place. So people have to be discerning when it comes to the quality of those contracts, the credit risk around those contracts, the tenor of those contracts. All of those things go into the calculus. So would I say that we're worried about that concentration risk right now? You have to see what is the credit support that's available under those contracts. You mentioned the OpenAI partnership, for example, with NVIDIA. Oracle is forward-leaning with their balance sheet. I think that has been a game changer in terms of attracting sources of capital to building out these kind of projects. So you have to focus on the key elements of commercializing an infrastructure project. It really isn't that different from doing an airport or a large-scale power generation facility or a data center.
That was the CIO of the infrastructure group at Carlyle and Brookfield Asset Management's CFO, speaking with Bloomberg's Heather Harris. Coming up, much more from Bloomberg's Women, Money and Power event in London.
Realizing that we've been in a period of time where we've had ultra-low interest rates, a lot of fiscal stimulus, this ongoing globalization, this chapter is coming to a close. Clearly, America is focused on America first.
Global markets are being reshaped by geopolitical tensions and shifting currency dynamics. So how are some of the most influential voices in global finance managing that volatility? Bloomberg's Francine Lacroix put the question to the CEOs of State Street Investment Management and leading global asset manager Franklin Templeton.
When you look at around the world, what are markets most underestimating in terms of the risks out there?
On balance, we're actually very constructive about the markets. And, we're calling for a soft landing in the U.S. We think the ECB has done a really good job. We're obviously a little bit concerned with China and some of the structural issues that are necessary. And we're also working our way through all the tariff negotiations. And I suppose maybe that's the piece of it, which is realizing that we've been in a period of time where we've had ultra-low interest rates, a lot of fiscal stimulus, this ongoing globalization. This chapter is coming to a close. Clearly, America is focused on America first. And so that notion of just buy the S&P 500, if you own that for the last couple of years, you would have been just fine. It's all about making sure that portfolios are very diversified. Because it is difficult to price in the uncertainty and volatility. And so I don't have necessarily a risk that we don't think the market is thinking about, but from the perspective of investing, holding gold, holding cash, holding private markets, being deliberate about all of that is in a very important way forward.
Jen, is there something you worry about, valuations?
No, I agree with Yie-Hsin on the point she's made. I would just add, I think the market may be a little bit optimistic on the number of rate cuts. I think that inflation is probably going to be, more difficult than to come in and maybe even, we might even see, I mean, obviously the tariffs are going to come through. You look at U.S. employment and, you on the one hand, the 900,000 jobs that, suddenly didn't exist, people say, well, is that a weak labor market? And yet you had wages go up 4%, in some cases 5%. And immigration had gone from like 3 million people coming in to now 1 million and even less. So that's absorbed. At some point, there's going to be continued wage inflation if you have less immigration in, right? And some of it's been offset probably by productivity gains in companies and some of those things. But I just think that inflation is a potentially bigger problem, and so you're not going to get the rate cuts that the market thinks it's going to get.
Because it's stickier.
It's stickier. And by the way, remember the big beautiful bill. Those I do call it tax extensions because there were more tax extensions in it, but some of that was front loaded, so that's going to be a stimulus for next year. All those things are kind of inflationary.
Yeah. Do you worry about inflation or the labor market in the U.S.?
Well, I'm going to disagree with you, Jen.
Okay. All right. Good. That makes a better panel.
So from our perspective, we do think the inflation hawks have it wrong. We've been worried about the labor side, and obviously the Fed has a dual mandate. And from our perspective, yes, we've seen some goods inflation, but the services side is showing deflationary pressures. And then when you think about housing and rentals, we see that really coming down. And so inflation, in our view, 3% last year. We think it's 2.8% this year, 2.6% next year. And wage growth is slowing. Unemployment is ticking up. It hasn't impacted the consumer yet, and that's one of the reasons why we're optimistic about the U.S. equity market. But we think it's critically important that the Fed continue on its path of easing. We're calling for another 50 basis points this year, 50 basis points first half of next year to really get to a neutral rate closer to 3%, which we think is more sustainable relative to the growth of the economy.
I mean, I know the Fed drives everything, but are you sometimes amazed at, given everything that's going on, geopolitics, China, there's multiple wars on multiple fronts, the debt concern, the U.S. government shutdown that we're experiencing, that, the markets are a little bit too focused just on interest rates?
Well, the consumer's still doing great in the U.S. I mean, they're still spending, and actually, if you look at the market, I mean, earnings are pretty good. You still have pretty good earnings growth. I think there are segments that some of the policies are really hurting. I think like agriculture, hospitality, some of those things. But in general, the market's still and the economy's still really strong. So I'm putting on the side of saying that. We're going to have good markets here, and but again, that's why I think we'll have a little bit more inflation than the Fed. So I would put it at the 25 basis points one time this year.
I mean, there's not a single day that goes on without us talking about private credit, private markets. Is there anything that we're underestimating, actually, with the very rapid growth of private credit?
Look, again, I always say with private credit, you got to remember that banks used to be the lenders. Capital requirements were such that it changed it, so now that's shifted into the private markets. I think the key is, but this is consistent with any credit. With credit, you always have to find where the opportunity is, right? So right now, you look at the high yield market and even the private credit market, some portions of it are priced for perfection. Right, like you want to know people are optimistic about the economy? Look at the fixed income markets. So you have to find where there's opportunity, and the key, I think, is to remember that private credit is illiquid, and therefore you have to get a premium. You should get a premium for that, so kind of demand that. Am I worried about private credit? Not yet. What I've said, one thing that is a concerning trend is as you get into these perpetual products from drawdown, it's always a bit riskier when you have to deploy capital in the case of credit, because sometimes you're better off saying, well, you're not getting the risk-adjusted returns that you should for it. So I think that's just a trend that we should keep our eye open on.
The CEOs of State Street Investment Management and Franklin Templeton speaking with Bloomberg's Francine Lacroix. Coming up, much more from Bloomberg's Women, Money and Power event in London.
If you look at in the private landscape today, there are more public to privates being done in the last 2 years. We've done 25 in the last 2 years, just to put it into context around the world, right? And it's because you can do some of that change as not in the public face every day.
Over the past decade, private markets have become a defining feature of global finance. Bloomberg's senior executive editor Sri Vidya Bhaktavasalam spoke to industry leaders about the opportunities and risks that lie ahead as the space matures and examines how institutional and high net worth investors are changing the way they think about the asset class.
Why are there more private companies today, right? If you look at the other stat that I think is super interesting is there are 40% fewer public companies today than there were 20 years ago. So what's driving that? Why do companies want to stay private for longer? And how do they need different financing to support their growth, right? For us, it's all about a growth story, and I think that's really important. As a private company, what you're really focusing on is the velocity of change within the company to really focus on the profitability, the bottom line operational growth of the business, how do you reshore management, all of those things really, really matter. And I think what's happened if you look at the last 10, 20, 30 years is that when you're managing to quarterly earnings, that's very different than reinvesting in the business, right? How you use your CapEx, how you think about your free cash flow. All of that really changes. So when you think in the context of what's happening, right? I mean, if you look at in the private landscape today, there are more public to privates being done in the last 2 years. We've done 25 in the last 2 years, just to put it into context around the world, right? And it's because you can do some of that change as not in the public face every day. And there's nothing wrong with that. You may be public one day in the future again, but some of that change you could do in a very different way. Now, where do the banks play a role in that? You need the financing to support it, right? You're not going to do it all in equity. And having that type of partnership, having that type of relationship where you can have the sources of capital to support that long-term growth, by the way, that's a good thing for everyone. It's a good thing for investors. It's a good thing for public companies in the future when some of these companies go public. And it's good for the employees of these businesses, right? I mean, it's one of the reasons why we spend so much of our time making sure that in the businesses we buy, we have universal ownership, right? It's not just C-suite. It's the same as in our company, right? At KKR, we all share in everything we do. Why can't you do that in a private company as well, right? So I think a lot of those best practices we're really able to push through, and that partnership with the banks, especially on the financing side, has been very important.
From Apollo's perspective, we've got a 700 billion credit business, and the overwhelming majority of that is within our investment grade business. So when we look at the business, we look at it with the lens of how can we serve their needs. And it's interesting, we talk about private capital, the definition of just private credit in itself, we look at it as a little bit different. It's often referred to as the leveraged loan market, usually sponsor-backed. And that's a subset of a subset. For us is a 40 trillion market and predominantly an investment grade market. So to go back to your question on the banks, everything that's on a bank balance sheet is private credit. So a loan to a corporate is private credit. A mortgage is private credit. A loan to consumer is private credit. Credit card loan is private credit. So that's the lens by which we are looking at this market. And yes, there's no question that we have different business models. So a bank often has a very strong origination business, and they have different regulatory capital requirements, and they borrow short, and lending long is something that can be very punitive, and there's been a lot of regulatory changes that have changed this, and we have been talking about debanking different rates across the world. And if you pair this with private capital, from our perspective, we care about the underlying asset and making sure that we create alpha across the risk spectrum. So being able to, originate something in a bespoke way means that, we can maybe get access to some of that source in the bank has. They can get paid handsomely for the services they provide to their client. We get a good asset, and, the way we see it is a win-win.
And I would just add the other part of large financial firms like Morgan Stanley and banks that have a large wealth management business is our ability to distribute the funds that they're raising the money for. And increasingly, our clients are asking us to innovate with them and with our asset management partners. So the ability to raise funds means that we've done $250 billion in alternatives since inception. We raised $35 billion last year. But increasingly, our clients are saying, okay, we love the funds that you put on your platform. We know you're doing the right diligence, both from an investment perspective and an operational due diligence side. But we also are asking you to bring us co-investment opportunities. And the asset management partners that we work with have been critical partners in bringing that flow to our clients.
So what are the pain points in that relationship?
Well, the pain points are areas where our clients will come to us and say historically they didn't love the reporting around some of the fund structures, so they wanted a little bit less friction in the process from a paperwork perspective, tax perspective, and our asset management partners have responded to that really well.
I mean, I also think the wealth market has fundamentally changed, right, in the last even 5 years, right? So when you think about how individual investors have tried to access private investing, right? Now, why is it important? It's important for a few reasons, right? Typically because if you're investing in private in the right way, you should be receiving a premium from a return standpoint against what you would be receiving in the public markets, right? So what does good look like in private equity? It's probably 500 to 700 basis points above the public markets, right? So that's the attraction. But the question to date has been, how do you get there? How do you get access to it? Private investing has really been in the hands of the largest institutional investors for the last 50 years, right? The way a private markets fund raises capital through a closed-end fund has literally not evolved in 50 years, right? The way you buy a house has changed, right? Like everything is true. The way you finance a deal has changed. So what we're starting to see in the last several years is this whole concept of evergreens, right? This whole concept of always on, right? And I think that's taken a lot of the frictional points out of those relationships where you can decide when you want to invest, you can decide when you want to exit. And in the meantime, you optimize diversification, you have a higher velocity of compounding in your returns because of the structures. But I think to your point, you've got to be with the best-in-class managers, right? You've got to be with those who understand the cycle-tested nature of the business, know how to drive returns. And if you can do that, I actually think it takes out a lot of the frictional pain points. And what we're doing is giving individual investors that same opportunity that a large institutional investor should have. But we're doing it in probably a more streamlined, less frictional way.
Liz Dennis of Morgan Stanley, Natalia Situra of Apollo, and Elisa Wood of KKR, speaking with Bloomberg's Sri Vidya Bhaktavatsilam. Women's sports have seen record audience growth, sponsorship interest, and cultural momentum in recent years. But institutional investment remains cautious. Bloomberg editorial lead Jacqueline Simmons explored the hard truths with industry insiders, discussing where money is actually going.
If you look at the growth metrics of women's football, selfishly, in this country at the moment, it's phenomenal. We are the fastest growing sport on the planet. Our participation is up in this country. The interest that is around women's football is at a real, to your point, we're at a real moment in time to be able to capitalise on it. And if I was an investor looking to come into football in this country at the moment, I'd certainly be considering women's, because I don't have to invest an astronomical amount to become the best in the world, to really be put on the global stage, to be winning Champions League. Whereas if I wanted to do that in men's football in Europe, that's going to cost me a lot of money. That's a higher risk investment.
That's a wrap for the second Bloomberg Women, Money and Power event in London. You can find more from top voices in finance at Bloomberg.com.